Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet, unqualified, to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. What does extended term insurance mean? So extended term is what's called a non-forfeiture option on your policy. It is essentially a paid up term insurance, but for a limited period of time. It doesn't earn dividends. It's essentially, converted to basically converting a whole life or universal life to term insurance. If and when you don't, usually on whole life, if for whatever reason you don't pay the premium and you don't have enough cash surrender value, or not enough really to keep the policy in force, they will use whatever is left to then buy extended just a term policy, and they use whatever cash value is left over to buy as much term as they can for as long as they can. The company will. Normally, the first line of defense is to use what's called an automatic premium loan. So the company will first try to borrow against the policy to pay the premiums. And then if that option runs out, it's just not enough money, then they move on to the extended term insurance. That's usually the default option. There's other options, but that's one of the more common default options. The extended term does not earn dividends, and it's only available if you lapse your policy, and you were typically, the companies will say if you're rated standard or better. If you're substandard, they don't want to offer you an extended term policy. If you have a substandard rating, they more likely than not, they're going to issue a reduced paid up policy on lapse. So this is basically just fallback insurance if you happen to lapse your permanent policy. So the way this typically reads, and I'll read this from an actual policy contract. The way this typically reads is it goes kind of like this. So the contract says the amount of ETI, or extended term insurance, is the sum of the face amount of your policy, the amount of any paid up additions, and any dividend credits, less any policy debt. So they take the combination of your face amount, any PUAs you have, dividend credits that you're earning this year, and then subtract out any policy debt. The insurer will use the remaining cash value to figure out how long the extended term policy can remain in force. So while, there is technically still cash value associated with this kind of term policy, it doesn't have a loan value. You can't borrow against it. You could theoretically surrender the term for the remaining cash value of your policy, though. Some companies will allow that. But you'd have to check in your policy contract to see what the exact terms and conditions are. Every carrier treats this a little bit different. Some of them will have more, different exact terms and provisions. You could learn about that exactly how that works, and if you have a policy that has that. But just by looking in your policy under non-forfeiture options, they'll spell it out for you. Anyway, I hope that answers your question, and we'll see you in the next episode. Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email
And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniX.com, and sign up for my daily email list.